Tom, and it's great to have you back on. How are you?
Yeah, I'm really good, thank you. Thanks for having me back.
No, it's always very interesting. It's very timely as well, as I think we'll get on to later in the podcast. And of course, Kenny, how are you? Shall we do our standard weather report? I can start if you like, because actually it's a lovely winter's day here. It's very anticyclonic with blue skies and lots of nice sun, but it's a little bit chilly in the air. What's it like in Scotland?
Yeah, it's pretty cool, but that's standard. Bit of sun, bit of wind, bit of clouds. It's not bad. I mean, it's been pretty much pouring rain all weekend, so it's quite nice to get a bit of blue sky now and then. What about yourself, Tom?
I'm down in Newark today, so we've got really nice clear skies, sunny morning, bit of ground frost this morning as well, actually, which was the first time I've seen that this year. So yeah, nice winter's morning.
Good
stuff.
Yeah, you get some really nice days in the winter, I think, don't you? Very pleasant if you can wrap it warm. But yeah, so here we are. It's coming to the end of the calendar year. So what is it? What's coming up then, Tom? Which people should be aware of from an accounting point of view.
Well, I suppose the immediate thing on the horizon for us is the self-assessment deadline. So that's for your personal self-assessment tax returns. The deadline for that is 31st of January. That's for filing and paying in most circumstances. And yeah, that covers the tax year from 5th of April 2019 to 5th of April 2020. And to be honest with you, that's what we'll be mainly flat out with between sort of December, January time. It gets a bit busy with the last minute returns.
Yeah, and what are the implications, Tom, if you don't comply with that deadline?
The initial one's the late filing penalty, which is £100, and then the penalties sort of increase depending on how late you are. There's also late payment penalties now as well that start at £100. So it really is sort of worthwhile getting it in on time.
Yeah, definitely. And bizarrely enough, I mean, we'd arranged this podcast a couple of weeks ago, and I had my own accountant on the phone on Friday, and it was a bit like me going to the headmaster's office, so it was at school. I thought I was doing really well. I had my books up to date. Everything was hunky-dory, or so I thought, but he soon told me otherwise. But I mean, it's just small things, but obviously he's trying to get my books out. My tax year, or my company year, ended on the 31st of May, so we've got a sort of 9-month window. But obviously COVID has changed a lot of that. So what is the actual rules at the moment for business accounts and getting your tax returns in?
Yeah, so for a lot of companies, depending on when the year end falls, because obviously with a limited company it can fall at any point in the year, then the usual deadlines are you have 9 months to submit those accounts to Companies House, 9 months to pay any corporation tax that's due. You actually have 12 months to submit the corporation tax return, which I know is a bit sort of counterintuitive, but there you go. Companies House have actually got a filing extension on for a lot of companies. It's worth checking whether it applies to yours in any particular situation, but they've actually extended their deadline out from 9 months to 12 months for a lot of companies, just to give people a little bit more time to sort of prepare the figures. A lot of accountancy practices have been running at sort of like half levels. They've had staff furloughed, so things have taken a little bit longer. There's even big sort of listed PLCs that are currently suspended. I think Saatchi's one of them. They've not been able to submit their audit on time. So it's right across the board. Things have just taken a little bit longer, and I think Companies House have sort of realised that and decided to push out their deadline a little bit.
Yeah, and tax implications, have they've been pushed out further as well?
No, I mean, the tax implications remain as they are. What HMRC have done is they've got specific dedicated lines now that you can call, such that if perhaps you've struggled cash flow wise because of COVID and you need a little bit more time to pay your corporation tax, you can actually call them up and come to time to pay arrangements with them in certain circumstances. But they've generally been pretty good to deal with across the board. I think a lot of clients have had good experiences dealing with them in this last sort of 6 months, in terms of talking to them about the corporation tax and trying to, space out the payments a little bit. The important thing with HMRC is contact. It's better to contact them than to have them come and contact you to tell you that you're late.
Mm.
Yeah, definitely. I actually had a letter for HMRC last week, but it was actually a tax refund. believe it or not. So
Right.
I was quite happy with that. It was £627.
That's always nice.
Yeah, but I've got a funny feeling that something doesn't smell right, and I'm sure they'll catch up with me next year and say that I was wrong, and I'll have to pay it back. But at the end of the day, they'd sent me a letter. I pretty much ignored it. Spoke to my accountant, and he said that's not right. And so I just thought, you know what, I'll just, so easy nowadays with the phone. You just take a picture of the check, put it in the bank account, and then we can sort it out. Next year. But bizarrely enough, obviously my wife helps me with the business as well, and this is what I couldn't get my head around, and maybe you can explain this as well better, Tom. So my wife was in full-time employment. She took the waitress she was working for, John Lewis, and they shut the shop, so she made redundant, which is fair enough. And she was due a tax rebate, which is fair enough, but I had to pay it through the business, which I can't get my head round. But then the accountant says it will catch up next year and it'll come off as a deduction before tax. But I still can't get why my business has got to pay a tax refund for HMRC. It just doesn't make sense at all.
Yeah, without seeing the specifics, I understand why that's confusing. I'm imagining they're going to adjust it through the tax codes next year, but certainly want to keep an eye on that. I'm not 100% sure what's gone off with that one, to be honest with you, Kenny.
Yeah, I mean, it was almost £1,000, which it's not a massive amount of money in the bigger picture. But I mean, imagine if you were right in the struggling to make ends meet, and you get your pay slip in from the accountancy practice, and you've got to pay your wife, an extra £1,000 in 1 month. And you're like, I don't know. Anyway, don't worry, it'll catch up next.
Well, it's a strange one. So that's something that you have to pay, but it's from something that's not relating to your business.
Yes, it's a tax refund that Paula was due, and I've got to pay it through the business.
And then it'll come back, presumably, somehow.
Yeah, it'll be reconciled next year. So basically, it's almost like I'm loaning HMRC this money. So that's why when the check for £627 came in, I thought, do you know what? I'm just going to put that in. It balances off
some of it,
yeah. But strange one. But there we go.
Yeah.
Changes coming up potentially as well, Tom, with capital gains tax. And I mean, most of it's way over my head. Can you maybe summarise what was likely or possibly going to happen at the end of the tax year?
It was big news. It was big news about a week ago. So we had a 135-page report from the Office of Tax Simplification, which doesn't sound very simplified to me, but there we go. And it's a capital gains tax review. I think we spoke about this last time, that it was in the pipeline. Basically, with all the COVID funding, I think, we were into about £210 billion of COVID support by August. And obviously that's still running. They've got to try and bridge this gap somewhere. And one of the easiest tax for them to look at is capital gains tax. So I think 2018, we raised £8.3 billion in capital gains tax off 265,000 tax returns, which you compare that to 180 billion off 32 million taxpayers. So, technically there's scope there, or they've seen that there's scope there to raise a lot more money from this tax. So they're looking at sort of 4 or 5 key recommendations. The sort of most basic recommendation is simply to increase the rate of capital gains tax. So at the moment, you pay 10% capital gains tax or 10% capital gains tax or 20% capital gains tax, depending if you're a higher or a basic rate taxpayer. Mm-hmm. Compare that to the actual sort of tax rates that you pay at higher or basic rate, and it's quite a long way off. So they've got quite a long way to go to close the gap between income tax and capital gains tax. So, for example, if you're paying 20% as a higher rate, but you're paying 45% further up the tax chain, then they've got 25% to sort of grow into there and start increasing it. Obviously, those rates for property increase as well. It's 18% on capital gains for a property for a basic rate taxpayer, 28% for a higher rate taxpayer. So again, there's quite a big gap and quite a big difference between the rate of capital gains tax and the rate of income tax. That's sort of the initial grab that I think they're going to look at in terms of trying to increase those rates a little bit. that gets compounded a little bit because the other thing they're looking at is reducing your annual exempt allowance. So if you remember, everybody gets a capital gains tax allowance every year. That's the amount of capital gains you can earn before you pay any CGT. Currently, that's £12,300. The idea of it serves three purposes. One is it's a relief in line of income tax. It's a crude measure to compensate for inflation. And also it helps them with the admin. It literally reduces the number of returns going through the system. What they're looking at possibly doing is reducing that. And they've suggested two possible scenarios. If they reduce that allowance to £5,000, they believe that the number of people having to submit returns would double. So you go from 265,000, which it was in 2018, to way over 500,000 people having to submit capital gains tax returns. If they reduce it to £1,000, then they assume that it's going to roughly triple the number of people in the capital gains tax system. The result of that is that they're looking at broadly about £14 billion worth of extra revenue. So it's quite attractive for them to do. They're the initial ones. There's some other proposals within that, which I'll come on to in a little bit, but they're the main two that are going to have the largest effects. I mean, capital gains it's not a wealth tax as such, but most people that have capital gains generally fall into the higher rate tax band anyway, just by nature of the assets that they've got and the value and the increase of those assets. They are usually, you would find that they are higher rate taxpayers. And I think that they see this as a way as a way to generate revenue and bridge some of this COVID gap.
Do you think it's highly likely that it'll happen, something?
Yes, I do. I think the government, it's politically difficult because of the voter base that the Tories have got. I think capital gains tax does affect a lot of their core sort of voter base. However, they are backed into a corner a little bit with certain taxes that they've said they're not going to raise. They've got to generate some money from somewhere, and it's an easier pill to sort of sell this one because there are disparities between the rates of capital gains tax and the rates of income tax.
Okay. I was talking to a chap called Ben Habib, who runs a listed company called First Property Group. It's an investment company in commercial property. He's very vocal. He was an MEP. He's very vocal on Twitter and that kind of thing. And he sort of some opinions on certain things. And we were chatting about this, and he says that his opinion is that actually at the moment the government should actually be cutting taxes, and it'll hurt the exchequer in the short term. But you've got to make the average Brit feel wealthier, get some money going around the system, get some investment going, get this levelling up thing that Boris keeps talking about actually happening, and get some growth. He said you've got to grow your way out of it. And we sort of talked about Osborne and Osborne's fixation. And it was a fixation on balancing the books. That's all he ever talked about. And he never achieved it. And we had just years and years of austerity. And I kind of agree with Ben. I kind of think that I think maybe the government should just back off on taxes for a bit and just try and let the economy grow out of this. And yeah, it will hurt in the short term, but then when the growth is there, when the innovation comes through, then you can tax it to try and balance the books. I mean, I don't know what you think on that, but I just think that doing this with capital gains, it'll only serve to increase tax avoidance, won't it?
Yeah, absolutely. I think there is a note in the report to this, which is that taxpayers will adjust their behaviour accordingly. We're sat here talking already about possibly preparing for it. We'll talk about things like ISAs and SIPs and tax shelters, tax wrappers to get to sort of minimise the capital gains tax implications of this. But it's true, people will adjust their behaviour accordingly. Perhaps won't raise the revenue that they're projecting. And I think you've also you've got to bear in mind that it potentially runs the risk of running a lot of investment out of the economy. You're right. People might look at those buy-to-let properties and think, well, when I look at the capital gains implication of getting out of that, it's not worth it.
Yeah, it's a funny one, isn't it? It's a tricky one because on the one hand you've got all this government debt, and that is a concern, I think, for the government first of all, but also for other people who are aware of it. It's only got bigger in the COVID crisis. But, I mean, also, I do think the UK lacks innovation and lacks that kind of, that productivity and that sort of growth that it sort of had. and there needs to be some kind of government initiatives, government programs, I think, to focus on that.
Absolutely, and I think one of the recommendations in this report is to do away with something called investors' relief, which is a relatively new relief for people investing in unlisted companies. And it was a 10% tax relief, basically, if they exit that investment within 3 years after April 2016. So nobody's really had a chance to use it yet. But the justification within the report is that they want to do away with it because nobody's using it, or everybody thinks it's a waste of time. And well, it's not really publicised. It's not been massively talked about as a relief. It's not being pushed out there. But if you want to get growth sort of from the ground up, they're the sort of things you need to be looking at, because people aren't going to put money into things if they think they're going to be, taxed out the other end, 3, 4, 5 years time.
Yeah, I mean, from my perspective, Tom, I mean, I'm 48 and I'm looking at my SIP, and I actually mentioned this to my accountant on Friday. I should really start channeling some money into my SIP as a not a way to avoid paying tax, but to be more tax efficient. And I'm assuming changes in CGT will probably accelerate a lot of contributions to a SIP, for instance.
I think absolutely. I mean, you've got a £40,000 cap on investment in a SIP in any year. The gains in there are tax-free. The dividends in there are tax-free. The same with the ISAs. You've got £20,000 on an ISA that you can invest in a year, and the gains in there are tax-free. Junior ISAs, if you want to get the kids involved as such, they've got £9,000 worth that you can invest on their behalf throughout the year. And then obviously it's looking at yourself if you're married. It's looking at your partner's situation, whether you can utilise their allowances as well. And I think it's just a little bit of forward planning now is what's required between now and the next tax year. I mean, this hasn't been announced. There's nothing formally being decided yet. But I do think that it seems to be a very opportune sort of area for the government to look at raising some extra money, because they're going to have to get it from somewhere.
Is it just one ISA you can have, Tom?
It's one ISA. Yeah, you basically, yes, it is, and it's a £20,000 limit in the year, and then obviously that resets every April.
Yeah, okay. So you can't, if you might have multiple brokers, for example, if we're talking about stocks and shares ISA, but you can only, with one of them, you can only set up an ISA.
Yeah, effectively, they like it in one. Yeah.
Well, we'll have to see. I mean, what's the time on it? Is it this year he wants to make an announcement? Is it on that?
No, there's no set time limit on it. I mean, the report was commissioned in July. It's just been issued. They've got to run the actual numbers on it. They're not suggesting specific percentages in terms of if they want to increase capital gains tax and where they want to take it. And then obviously it's got to go through. It'd have to go through Parliament. So I would expect possibly a gradual move towards it in the next budget. If that's the way that they're going to go with it.
And will this change the way that, because I know a lot of sort of not self-employed but directors of small limited companies will pay themselves through that method, won't they? So they'll take like a minimum salary through the PAYE and then pay themselves sort of the rest in dividend. Would that discourage that kind of thing then?
No, I don't think unless they start looking at possibly increasing dividend taxes.
It's different. Sorry, I'm confused. Yeah,
No. It's again, but it's something else that might be considered. I mean, it used to be that for effectively self-employed directors paying themselves out of a limited company up until sort of 3-4 years ago, didn't pay any tax on the dividends that they took out of that company. Right. Then they brought in the incremental tax, so the first 2,000 are tax-free. And then everything up to basic rate is taxed at 7.5% on dividends. And the idea with that was that it was to compensate for the fact that you're not paying class 4 national insurance contributions, which you'd be paying if you were self-employed. And then obviously the 7.5% band jumps up massively to 32.5% once you get into higher rate. So again, dividend tax, I wouldn't be surprised if they had a little look at that, although I think that might meet a little bit sterner resilience, given that directors of unlisted SMEs, a lot of them feel a little bit aggrieved because they've not had a great deal of COVID support throughout this process.
Yeah, well, that is true, isn't it? A lot of them haven't had the support, but then I was talking to one guy who does runs a flooring company, and he sort of said, yeah, there's not much COVID support. It's only the basic, but he kind of said, well, you might benefit here, but you lose there, and that kind of makes sense because in effect, I suppose he's been paying less tax generally.
Yes.
But then but when the brown stuff hits the fan, which it did earlier this year, then okay, they're not in line for the support, so you kind of lose out there. But then again, this situation's a bit unprecedented, so what do you do?
The support thing's difficult. They were never going to be able to cover every base and every eventuality with it, and then also try and protect themselves from people exploiting the system effectively. So I think possibly the self-employment grants could have done with being reviewed. I think they're still working on 2019 tax returns for this next round of self-employed grants. So self-employed individuals, so subcontractors, and people that are trading in their own name get another grant on the 30th of November. But again, they're only eligible for that if they filed a 2019 tax return. So people that set up in business after that are still missing out on support, which, I think maybe the time to bring that forward was now. But there we go.
I'd imagine as well, Tom, from a limited company point of view as well, you'll probably find there's a lot more family members will be joining the books of a company now as well, because obviously that's a tax efficient way as well.
It is, yeah, but again, HMRC will look at that and make sure that they're actually contributing to the business. They can't just be on there in namesake, so to speak. They've got to actually be working in that business and contributing in that business. And a lot of families do. We've got some really big clients that are genuine family businesses that have got family members in 3 generations, one of them working in the business, which is good. So I think that's probably, and I think with the job market as it is at the moment, I think that sort of return to family business might be something you see a little bit more of next year.
Okay. Yeah, definitely. COVID. I wanted to talk about COVID as well, because obviously there's so many changes been made and support mechanisms put in place. Obviously, Scotland's different from England, but obviously England went into this lockdown, I don't know, was it 2 or 3 weeks ago? I can lost track, to be honest.
It's been difficult to keep track of. I think the week before the lockdown, the second lockdown, we wrote 3 different updates on the changes to the job support scheme, literally because it was changing every other day until we eventually ended up back full circle onto the 80% furlough until next year. So the changes have been difficult to keep on top of, but then as you said, it's an unprecedented situation, and I think the last round of changes were designed to give a little bit more of a long-term picture, because after we sort of came out of the summer, things seemed to be sort of meandering a little bit. We'd got a tapering down of the furlough scheme. It was a little bit wishy-washy when the next self-employment grants, if there were going to be any, when they were going to land. And I think, the rise in cases have sort of led them to coming up with a little bit more of a definitive plan that should hopefully take us through into next spring now.
Yeah, Tom, I think I missed a trick with the bounce back loan. I think it came in sort of May sort of June time. Probably applied for too small an amount. So I did, or I put through my turnover at too small an amount. So, don't get me wrong, I just stuck the money straight into an investment, and it's done particularly well for me. But I know quite a few guys that have went for the full whack. And did they need it? I don't know, but I can see why the government's done it, because obviously if you're going to bang £50,000 into an investment and it goes up 2 or 3 times, and you can rinse and repeat that over a period of, up to 10 years now, the government are going to claw that money back in CGT alone before you even pay back the loan. So I can see why they've done it.
Yeah, the bounce back loans are interesting. I think they've ended up being quite good in a variety of ways. I think some businesses have used it to reorganize their asset base a little bit, which is something that they might have needed to have done to get through this sort of period. It's incredibly cheap finance. It's up to £50,000 or 25% of your annual income, whichever's the lower. The application processes were generally quite quick. The funds getting into clients' bank accounts seem to be quite quick. And now what they've done is they've extended it. They extended it in 2 ways. So they extended the repayment period from 6 years to 10 years, which again has brought the payments down for a lot of businesses. And then they've also announced the top-up extension. So what you can do now is if you didn't take your full allocation first time round, you can effectively reapply to top up that loan. That works on the basis of whatever you declared your turnover was on the initial application. So, if you've put down that your turnover's 100,000, you'd have been entitled to 25, but you might have only taken 20. You can now go and claim that extra 5 if you want. So yeah, it's been a relatively good program, that, in terms of keeping certainly the smaller end of businesses going. I think they initially had the CBILS, which was 250 plus, 250,000 plus, and a lot of businesses, I think, were struggling to access that. This seems to have been a little bit more for everybody, and seems to have helped a lot of businesses out.
Because it is very cheap, isn't it?
Yeah, it's I think it's 2%, 2.5%. After the first year, so there's no repayments on the first year as well. So again, it eases cash flow for people. It's government underwritten if you're trading through a limited company, although technically you are still liable for repayment on that. So, but again, it's very, very cheap finance.
Mm-hmm.
Yeah, I must admit, there's always with these things, there's people, try to scam and make money out of these bounce back loans. And I've seen a couple on Facebook were just absolutely ridiculous. It was a guy, it was buying, I think it was, let's say it was a £50,000 Audi. I can't remember what make a car it was. But basically the guy bought this car using a bounce back application for the garage.
Right.
And got away with it. Just about. Get caught at the very last minute, but I imagine there is people somewhere in the deep and murky world of crime that are probably making money on this bounce back scheme, because the checks can't be as complete as a standard loan you were getting from the bank.
They're not, and I think that's what's left it perhaps prone to some exploitation, because the checks aren't they're not there. I believe with limited companies there's no credit check on them. However, with that said, there will be a reckoning with all this, I believe, when things settle down, a little bit like the job retention scheme as well. HMRC are already well into that and investigating claims. And I imagine the same will happen with the bounce back loans, especially people that are trying to walk away from them once insolvency practitioners get involved. I think, when you get into the fine print of those loans, you'll probably find within that they can still come for you personally. So it's certainly worth making sure you've read the fine print.
Yeah, definitely. But all right, well, I think that's quite a good chat, Tom. That's probably been about sort of 35, 40 minutes. Is there anything else you want to cover that you can potentially maybe see coming up in the next 12 months? Any surprises from the government? Or do you think they've already kind of announced them?
I've given up trying to second guess this government, to be honest with you, because they whatever comes out next week, you don't know how long it's gonna hold for at the moment. So no, we're just sort of, it's like everything else. The thing that we're trying to do and emphasize with clients is to be prepared. Do your budgeting, do your forecasts, work out your worst case scenarios. I think from our point of view, what we're seeing is that a lot of the potential insolvencies have been kicked down the road. I don't think we're anywhere near where we're going to be in sort of 6 months' time with businesses sort of going under, and once those sort of support mechanisms start getting taken away.
Yeah, and we've not really spoken about the main elephant in the room either. We've not spoken about Brexit and what implications that could have as well.
That could fill an entire podcast on its own. That might be,
I know,
for a few weeks' time.
Yeah, and it's still getting plenty of mainstream headlines, but the deadline's coming up fast. We'll get 5 weeks or something.
It's not long now.
No,
it's not long. It's unbelievable how unprepared and how little guidance is being issued on it today. It's crazy, absolutely crazy.
Yeah, the government haven't prepared for anything. I recently moved to Europe, and it wasn't. I mean, Brexit was a factor in it, but it wasn't. Yeah. I'd love to sit here and say, yeah, Brexit, I left the country, but it wasn't solely because of that. There were other reasons. But I do kind of like sitting here and looking back and just seeing what the government are going to do. When I look at sort of the preparations that the Netherlands have got in, and you go on the Gov website and it's like, guidance will be released shortly. It's like, oh, okay, right. Well, I know where I stand here with these guys. And even, Brexit, what implications that means for the people in the Netherlands. It's all here, like frontier worker permits, that kind of thing. You can get all of that. but not from the Gov, not from the UK one, not yet.
Just mad.
I'm going to put you in the spot then, Mark. What's going to happen? Deal or no deal?
Well, I think there's going to be a deal, but I think it's going to be I don't think it's not going to be the Brexit that that people who voted for it want, or indeed what Boris and his colleagues were promoting. I mean, I can't see I don't think there'll be a no deal. I just don't think the government can do it. I think they've had the opportunity to show that to walk away, as they keep saying they are, but I think the union have just called the bluff. And I don't see the government walking away. I mean, in a sense, it'd be nice to see it happen, and actually just have a clean break, because otherwise, I mean, no one's won. Because we'll be half in, half out. So it annoys the Brexiteers and it annoys the Remainers. But yeah, I think there'll be a deal, but it won't be what people who voted for Brexit wanted.
Yeah, well, I'm going to say they're going to kick the can down the road 6 months.
Well, and extend it again.
Yeah, I think so. What about you, Tom?
Yeah, no, I can see that happening. I think
Really?
they can use COVID to cover a multitude of sins at the moment. I think with the upheaval of a couple of weeks ago with Lee Kane and Dominic Cummings going, I think they were the two main advocates of a no deal behind the scenes.
True.
So I think we're edging towards getting some sort of deal. But yeah, it wouldn't surprise me if it was another 6 months before we got a deal.
Yeah. I mean, I think it's probably factored into the markets, and anyway, I think they're probably expecting it, and nobody would bat an eyelid if they say we're going to extend it to 31st of May. Whatever. Would just probably accept another 6 months of nonsense. But
yeah, there we go.
It's just uncertainty, isn't it? For a lot. I mean, it doesn't particularly affect me, but imagine if you're in the import and export business, it must be an absolute nightmare.
Yeah.
Just trying to get all your ducks lined up for what might happen or what might not happen.
Yeah.
Good. Well, on that note, appreciate your time on Monday.
Thank you, Tom.
Morning, Tom, because Monday's usually a busy time for me, so I'm assuming you're the same with people thinking over the weekend. I need to speak to my accountant on Monday, so I'm assuming you get a deluge of calls on a Monday.
Absolutely, yeah. Monday, the Monday inbox is always the busiest one to deal with.
Yeah, all right. Well, we'll get you back on pretty soon. I mean, it was too long from the last one. It didn't seem that long ago, but it was almost like 5 months. So.
It was, yeah. It's flown by as well, hasn't it?
Yeah, well, we should at least get you on, at least once every couple of months, because there's so many changes.
Definitely.
And we'll maybe try and field some questions for next time. We'll put out well in advance that you're coming on, and we'll see if we can get any specific questions for the podcast.
Yeah, that'd be good. No problem at all.
All right. I appreciate the time, Tom.
That's great. Thanks very much.
Thank you, Tom.
Till later, guys. Cheers. Bye.
Bye.
Thank you for listening to another podcast from Market Musings with Fairbairn and Russell. Tune in next